Okay, good evening, everyone. Welcome to another episode of Wednesday Night Sequoia Enterprise Solution. Okay, are you guys seeing the presentation? Yeah? Okay, great. Okay, got it. So, what are we going to be talking about tonight? Um, why commercial loan fails. Now, we've been talking about a lot of success stories. For the last month or so, we have various different agents come online to talk about their success story, talk about why they closed the deal, their experience with Sequoia. Those are all good things. But we also know, okay, nothing is that there's no companies always you can just talk about good things. You have to talk about the bad thing also. And I think the most important thing that we can learn is from our failure. The more we fail, the more we understand the business, the more we learn this business, and the better the success rate is. So this tonight, I'm going to share with you why loans fail. Okay, we have a lot of loan agents come on to us showing their frustration. Why this loan is not working? I submitted so many loans. How come they're not you're not able to close them? I have a team of loan officers. I mean, we have like 20, 30 people. They're all submitting loans. Why the success rate is so low? So today I'm going to share with you why. Now, obviously, we all understand one thing. What comes in, what goes out. So junk comes in, junk goes out. That's just the basic philosophy, basic understanding about anything, right? Whatever you eat in your body, you eat junk into your body, you become fat, you become unhealthy, right? So again, um, so commercial loan is so much different than any other loans. Commercial loan, it's a custom tailor product for each clients. There's no one size fits all. There's no such thing. So there's a lot of unknown variable or unpredictable. Now, obviously, we try to make things more as predictable as possible, but unfortunately, there's a lot of things that we cannot control. So before you submit loans to this to the platform, if you can watch out all these different type of um, traps or different type of you know possible factors that might fail the loan, and your success rate will be hopefully can be higher, right? So here I summarize about 10 different scenario or 10 different reasons why loan failed. But now they're not in any particular order. Every one of them is as important as the next one. So next time when you talk to your client, make sure you think about when they say something, think before now. You always put yourself in a lender's position. I think that's the best advice I can tell you. Imagine you are that person going to write a check. Somebody come up to you saying, "Hey, Alan, give me $10,000. Give me $20,000. Give me $1 million. Give me $10 million." As a lender, if you were the one that writing that check, what would you do? How would you see this particular client? Okay. So once you put yourself in that position, now your mindset start to change. Now you start to think differently. Because a lot of the time we look at the deal. We say, "Oh, wow, this is a good deal." We always standing on the side of the client. Okay. When we look at something like this, oh, this guy making great money. I know this guy's rich. I know he drive a BMW. He live in a big house. I know he makes a lot of money. His business got to be good. How come you cannot give him a loan? Now let's switch side a little bit. Let's sit on the other side of the table and look at this deal. And now all of a sudden you'll find out think the story is not the same as what you see. So the first reason I would say is called inadequate cash flow. Cash flow is it's just not there. Now, in commercial lending, most of the loan that we fund, we do not care about clients' personal income. They have a job, they have a business. It does not matter how much personally that they make. So oftentimes when people are asking us or coming to us saying that, hey, this guy makes a lot of money, this guy makes millions of dollars and he has a great job, it doesn't really matter to me. All it matter is that that particular project or that particular property, does that property generate any income? And if that property does not generate any income, most likely the loan Even though if we can do the loan amount might not be what they wanted. Give you an example. Okay, give you an example. We have a lot of clients come to us saying that, hey, this multifamily right here, this retail store right here, this mixed use right here, worth about $1 million. And this guy's credit score is 800. Can I get 80% of that $1 million? Well, it doesn't work that way, right? $1 million is just the what? It's just the value of the property. But in our business, there's one term is very, very important. It's called DSCR, debt service coverage ratio. I pretty much talk about DSCR every single time that I talk about commercial lending because this term right here is the most important term that any lender would watch, would use. So learn how to speak DSCR. What does DSCR basically means? It basically means the cash flow of that particular property, or basically means cash flow of that what of that business. So now again, you're talking about $1 million home, $1 million property, 10 unit, for example. Okay. Now the lender is going to ask you, what is the cash flow from this property? Now you're saying that, okay, fine. It's only generating $5,000 a month. I'm just hypothetically, right? So $5,000 a month is not able to support a 80% loan amount. 80% of $1 million is what? $800,000. It's not possible to support an $800,000 debt. In another word, the $5,000 cannot service the debt service debt service coverage ratio. That's what it means. The income cannot service the debt. So that is one of the reason, especially in today's market, we that's one of the major reason that a loan cannot go through. Because in a lot of people's mind, this is a good value property. As long as the value is there, I supposed to get the money that I want. But unfortunately, that is not the case. And another example, a building right here, you're only half occupied. You have 10 units, but you only have 50% occupancy. And the other 50% is not occupied, that's not generating any income. And that is why land is one of the most difficult assets to get loans because land does not generate any income. A lot of clients would think that, oh, I got a piece of land that value at $10 million, $20 million. Give me 50%, give me 75%. Now the lender's going to ask you, out of the $20 million land, if I give you $10 million, how are you going to support the $10 million if that piece of land doesn't even generating any income, right? So again, cash flow is what the lender's looking for. Now, obviously, we do have loans, we do have properties that does not generate enough income. For example, you purchase a foreclosed property, it's all vacant. There's no income at all. Can you still fund that loan? Absolutely, you can still fund that loan. But now it's structured differently, right? So in that case, most likely we can do is we can give you a bridge loan. A bridge loan, normally they might not care about income whatsoever. They're looking at the value of that property as its value, okay, not stabilized value. Now there's difference as its value, meaning that hey, what it is right now, what I see right now, what's the value right of that property without any income. Stabilized value meaning what? Meaning that hey, if I put tenant in there, I collecting rent, I stabilize it. Now what is that value? It could be a huge difference, but the lender will only looking at the as is value and provide a loan for it. So again, a lot of the people would in their mind they would think that oh this building worth about $10 million. I'm gonna get 70% out of it, 80% out of it. But in reality, the lender will only probably willing to give you 40%, 50%. So now the number does not match, it won't work. So that's the number one reason, inadequate cash flow. Now that leads to the next one. Appraisal value is not there. In today's market, we see so many property that the client telling us that, hey, this value of the property, this property worth about $500,000, $600,000. Okay, fine. We take your word for it. And sometimes we even go into Zillow, go into different online websites to check the value. Okay, so that is just an estimated value. So now, for example, let's say somebody were coming to us, they want to do a refinance. Give an example. Let's say the property value it's $500,000. Okay. Now he has a loan of let's say $200,000 and he wants to get cash out for $100,000. So total loan he wanted to get is 30 $300,000. So $500,000 value, $300,000 loan, that's what 60% LTV. Okay, 60% LTV. Okay, fine. That's great. However, once we do the appraisal, now all of a sudden we realize that the property is not at $500,000. The property is at 450,000. Okay, 450,000. Now, if you still take 60% out of $450,000, it's different. It's a lot less than $300,000. So now it cannot cover the payoff, or it cannot satisfy the need of that client because now the value is not there. And this happened many, many, many times, and especially with some of those uh, we right now we're seeing a lot of resident commercial properties, retails, apartment buildings. A few years ago, they got a loan with interest rate very, very low, and hence they can get a bigger loan amount. Now today, that bridge loan, it's mature. They have to refinance that bridge loan. All of a sudden they realize that the value of that property is not there anymore. Many of those property actually drop in value compared to a few years ago. Some of those areas that go up in value very, very rapidly, and now it's also come down very, very fast. So once you get into that situation, there's nothing much we can do about it. Now, obviously, we can challenge that appraisal value. We do that all the time. But most likely, when the lender sees one appraisal, most likely they're not going to change their mind. And also for the appraiser, even though you challenge their value or challenge their report, they are not going to, most of the time, they're not going to have that much of a difference. So this is the second reason that we see out there that loan cannot close. We have many times when the appraisal value comes back, it's not there, then the deal is dead. So that is the second reason. The next reason is the borrower. Okay. In our line of work, in commercial lending, we really, if the deal work or not, has one word, it's called risk. The lender will need to evaluate the risk. The risk comes from two sides, come from two angles. The first one is obviously the project or the property itself, which we talked about this, right? But the other side is from the client. They also need to evaluate this client. For example, credit score. Credit score is very important. A lot of people think that, oh man, this property is under an LLC. Why do they need to check my credit? Well, they do because again, that LLC is owned by you. They want to make sure that you, as the investor, is responsible, has the responsibility, or have the tendency to pay the mortgage. Because again, there are a lot of investor out there that is they they have all kind of stuff under their credit report. Okay, so the lender would like to know who am I dealing with. So client is become very important. If you have poor credit score, absolutely that's a no-no. Now we do have lenders that can fund. They don't care about your credit score. All they care is just the value of the property. Can we still fund it? Absolutely. If you really need money, we have lenders like this, but don't expect to have any good interest rate. Don't expect to have a high LTV, right? So if you really have money and you're willing to take a high interest rate, 10, 12%, 13%, or even higher, yes, they can definitely get it done. But in normal situation, a lot of the client is not willing to take high interest rate loan. So credit score is very important. And also liquidity is also very important because the lender would like to know, oftentimes they want to see, do you have the ability to pay that loan back to me in a certain period of time? And especially in some project that it's to the client is very risky. I mean, to the lenders, risky, they think it's risky. They will normally ask the clients to show 3 months of a reserve, other than all the closing costs, the down payment, whatever that might be. You still have to show me 3 months of reserve, 6 months of reserve, to make sure that for the next 3 months you can pay the mortgage. For the next 6 months you can pay the mortgage, right? And then also some cases the client will come up to us saying that, hey, I'm going to buy this building right here. The client get me a loan of 70%. I have a seller willing to carry a seller second of 30%. So as an investor, I don't need to put down anything. Can you find me a loan like this? Well, from an investor point of view, absolutely, this is beautiful. Using other people's money, OPM. I love OPM. But from the lender's perspective, it does not work that way. The lender want you as the client or the principal have skin in the game. Skin in the game is very, very important to any client, to any lenders out there. Why? Is because like this. If I go out there to purchase a property, the lender give me 70% and the seller give me 30%, I have no risk at all. If something happened, if I cannot, I just walk away. I got nothing to lose. Now, of course, I might ruin my credit, but again, I have no financial risk. So to a lot of lender, that is the biggest no-no. They want to see that you as the principal, you have skin in the game. Now, how much money that you have to put in? Now, obviously, the more the better, right? But we have lenders that minimum, you need to put down at least 10% because we do have lenders, some lender allow seller carry. Seller carry means that the seller is going to have a second lien as a second loan. Okay. Now, in some extreme cases, for example, like SBA loan, in some cases, we might be able to get you to 100% loan. Yes, we can do that. Okay. That is called business expansion. But you got to have a lot of experience. So that's another thing. Experience is very, very important. If your experience is no good or you don't have any experience whatsoever, lender's not going to give it to you. So again, liquidity is very, very important. So many times the loan cannot moving forward just because when we ask for the clients, hey, show me where the money is. Especially we are talking about big projects, constructions, renovations, um, type of deals like this. And oftentimes we have client come to us saying, hey, I got a project of 10 million, 20 million. Um, and the first thing that I ask them, or I suggest everybody in this room, learn to ask this question. When anybody come up to you saying that I need this much money, ask them the first question, how much can you put down into this deal? How much can you put down? And you'll be surprised. Sometimes they say, oh, I can put down a $10 million loan, I can put down 5,000. Forget it. Run. This deal is not going to close. Okay. Sometimes you will hear people say, hey, I can put down 20%. I can put down 30%. Great. Wonderful. Keep pushing forward for the second question. Can you show it to me? Where is this money? Have you raised this money yet? Oh, I'm talking about it. That means that they don't. If they don't, most likely this deal is not going to work. Because when you submit a deal to the lender and the lender look at this deal, a $10 million deal, $5 million deal, and you are only asking for 60%, lender would love it. But the lender was going to give a condition saying that show me your what? PFS, personal financial statement. Where it's your money. And if they cannot show it, that means that they don't have it. If they don't have it, then don't waste time. And again, we see a lot of loan fail through is because the client cannot show us adequate financial statement to support what they told us that they have. So that is the next reason, financial weakness. Environmental issue. Now this apply to pure commercial, gas stations, industrial, warehouses, dry clean, laundromat, properties like this. Environmental, um, if the property it's a multifamily, most likely client lender would not ask for environmental. However, the lender will check where the address is. So this is the trick. They don't just look at the property, they also look at what is surrounding the property. So let's say imagine that you have a multifamily right here, and you have a gas station on the left and you have a laundromat on the right, then in that case, they would like to see an environmental report. So they were afraid that, hey, what if this gas station did not take care of all these oil and chemical and leak into the soil, and would that affect this particular property? So they would, in that case, they would like to see an environmental. Now, obviously, if you're purchasing a gas station, there's absolutely they need to have at least a phase one. Now, environmental phase one, that is the initial stage. They want to check if everything's fine with phase one, it's fine. That's fine. We can move forward. Normally for phase one, it will only cost you $1,000, $2,000, not a whole lot of money. But if they found any issue with phase one, then now they need to go into phase two. Now that phase two is going to cost you a lot of money, at least in the tens of thousands of dollars, right? So, and now once they find a problem, they're not just giving you a loan like this. They have to demand that property, that issue need to be fixed before they can even fund the deal. Now, let's not talk about big commercial property, like just talk about single family home. An inspector go into a single family home and they found out that, oh, there's mold in the basement. What happened? Definitely, they need you to fix that mold before they will issue a final commitment or clear to close. So again, environmental issue we see, it's out there. We see it quite a bit, and especially with some people that purchasing some of the much older properties, it does have issue. So in some cases, because the environmental issue is so severe, the seller is not willing to do it or the buyer is not willing to do it, then obviously the loan is not going to be able to move forward. So that is the fourth reason. Title and legal issue. This is very true. No matter how good it is, I see Becky already. Becky, why don't you come up here and talk about this? You dealing with so many loans right now, they have title and legal issues. Share with us what happened, what you see in the back.
Well, thanks, Alan. You're right. I can't keep a straight face when when we start talking about this. Um, so there are once we get a title report, it will search for who the borrowers are, but it will also search on the property itself and to make sure that the property is free and clear to be loaned against or that the prior lender can be paid off or whatever. So what we've seen of late is some things that have popped up in unexpected ways. The other thing that lenders are doing right now is a lot of due diligence in the area of examining their fraud reports and tying those back into where clients are indicating that they live or have lived, and what is showing up on those fraud reports sometimes have to be addressed in regards to the title issues and if there's liens against the property. And these are not easy fixes. I'd like them to be easy fixes, but sometimes when you're working with, some title companies are smaller in nature, and the issue might be an out of state problem that we have to research, and so we try and figure out ways to get that research done and to make it be cost effective. Some of these will undoubtedly. Recently, we've had one that's turned up that wasn't out of state. It appears that it was a judgment. We have one of our clients indicating that that is not them. So when you're working with a lender, you're trying to what I call prove a negative. So how do you have someone indicate that it doesn't belong to them if they have a name like my last name is Brown? I get pulled into questions all the time because of my last name and that things that show up on my credit that have absolutely nothing to do with me. So and that can be a challenge. Some title companies are very adept at it. We will have clients that already, because they're experienced investors, they may already have an attorney, and they give me permission to call the attorney and say, hey, this is what we're trying to fix. What do you know about it? Um, the other thing is that back in the day when loans were refinancing really, really hot and heavy, a lot of liens from back in the day did not get released in a timely manner on residential properties. So either the title company has to get that cleared off, and if your borrower has an existing copy of a title policy, that might help them, or they'll have to work with the old lender to see if there's a way to get a release fashioned. So these can be really tricky because we don't know what we don't know until we get the report, which can be sometimes, 10 days to 2 weeks into trying to close a deal. And then we have to kind of pump the brakes and figure out how we're going to get it. The other thing that we have to be mindful of is, when people are investing, sometimes, maybe their very first investment on a property is from a family member or from, somebody that they knew. And they didn't go through a settlement agent to clear it up, or they didn't get a title review at all. So they have no idea what old liens are against the property. So again, those are just things that we learn as we go through and look at the title work, but they are things that can happen, and we do everything possible to try and get them resolved. We work very hard at that, and but there are times that there is just some things that we can't make happen in a timely manner, and need the borrowers to go and talk to an attorney to figure out the best resolution for them, because it doesn't always happen at settlement. So
Absolutely, and that's why we are so blessed to have Becky. I mean, honestly, for things like this, I wouldn't even know how to get around something like this. But because Becky's experience, he has been in banking industry, underwriting industry for more than 20 years, and she knows how to get around this. She knows how to talk to the underwriter. She knows how to talk to the attorney. And again, it's such a blessing to have you, Becky, to in handling all these issue. And I told my client, I say, look, man, we are cleaning up your behind right here. There's a lot of you didn't even know that how much crap you have until we dig out all this thing, and you should be thankful. And quite frankly, a lot of the client, they are not appreciative. They keep saying that, oh man, how come it takes so long? You keep asking me for this, keep asking me for that. Honestly, I don't want to. I can shut down this file. I don't have to do this file anymore. And you still have your problem, and I don't. But from our perspective, what we're thinking is that, hey, well, I'm here to help you out. I'm here to try to clean up your mess right here for you. And, bear with us. Honestly, we will do whatever it takes for us to get the deal done.
mhm.
Honestly, this deal, it's not a simple deal. I'm going to talk about it next. It's the same deal right here. It's not, it run into many different issues that this deal should have been dead long time ago. But again,
Yeah,
because of the team that we have, like Becky, like George in the back end, and the deal just keep coming back, keep coming back, keep coming back. And finally, hallelujah, we're closing tomorrow.
yeah.
Okay, so this is the title and legal issue. Now, another thing with legal issue, nothing with title. The title is clean, but it's legal issue. Let me give you
Mhm.
another example. Oftentimes, in a business, we see business partners, two business partners. They both on the loan, they both on deed, they both on, the operating agreement, and one partner does not want the other partner know that he's getting a loan out of this business or out of this property. Then we cannot get it done because the other partner is on the loan. The other partner need to know. So there's no way around it. We also have a loan supposed to close yesterday. It didn't close. It's just because on the loan is a husband and wife, and the wife want to get the loan. She does not want the husband to know. But the lender saying that, hey, we need to get a voided check from this particular account right here. We have to put the loan, put the fund, that loan into that particular account. And the wife say, no, 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 no. I want you to put into another account. The lender say, no, it does not work that way. Okay. Because you have the husband and wife. It does not matter you are family or not, but legally you have two people on that loan and both need to know about this. So again, because of that, we cannot get that loan done. It's that, right? So title and legal issue, we run into it all the time. So please bear with us. I mean, again, we don't want to ask more than necessary. But things like this, we have to go through it. We have to go through it. So please walk with us. Okay. That's the fifth reason. The next reason it's the property condition. Um, we don't know what the property looks like. And we can only base on what the client tell us. If you're a single family home, most of the time we say, okay, fine, no problem, just do whatever, I mean, we will move forward. We'll do the inspection. We'll do the appraisal. Then we find out what the property condition is. But in some cases, we want to see what's inside of the property. We want to see the interior pic. We want to see exterior picture, interior picture, and um, it does not matter if it's messy or not, right? We just want to see what's inside of it. Now, what make a deal go south is that sometimes the client modify the property illegally. Give you an example. We have a lot of um, single family home townhouses that is in DC, in New York, in Brooklyn, in one of those, town cities. So the client illegally convert all the rooms. They convert the living rooms, the bedrooms, the dining rooms. They convert the room into many different rooms and rent it out individually. That is no-no. So once we go in, the appraiser goes in and you look at this thing. This does not look like a house. And in that case, then you can for sure this property is going to go south. It's not going to work, right? So we run into a situation like this, and also we also run into a situation where people purchase a single family home or a townhouse, and they specifically ask us saying, "Hey, Alan, can you give me a loan without appraisal?" Now red flag race. Why you don't want me to go into a property? And the first thing that I will ask, the first thing I will ask is that did you do you have any cannabis business inside of that property? And quite frankly, you'll be surprised. 99 times out of 10, they say yes. So again, that is another reason. If you're doing something illegal inside of that property, no one is going to give you a loan. Um, we have the exact same. We have a case like this not about 2 or 3 weeks ago. Look at the property, beautiful property, nothing wrong with that. The guy saying that, hey, I'm going to, I want to just cash out from this property and I'll purchase something else. Nothing wrong. But then when the lender did a title search, it found out that there's actually a violation from the city saying that the property it's in it was in cannabis use. So that was actually a violation. And that violation has not yet been cleared. So in that case, it is a legal issue. It's a property condition issue. So definitely this deal is dead. And that property, I don't know what they can do with that property. He cannot sell. Obviously, cannot sell. It has a violation right there. He cannot rent it out. It cannot refinance. So again, that property has a lot of issue. So property condition is the next reason why we cannot close a deal. Market and economic shift. So this back to the scenario where Becky was talking about. That property, it's in Chicago. Okay, that property is in Chicago. Originally, it was with one lender. Everything approved. 3 days later, we supposed to go to closing. And then all of a sudden, a lender calls up saying that, Alan, we are pulling out away from Chicago just because there's a lot of default in that area for some reason. and they don't want to lend fund in Cook County, and they just pulled out because of the market, because they don't like that market. So then it forces us. Now that file should have been dead right there, but then we picked it up. We sent it. We looked for another lender that's still funding in that area, and finally we found this lender and put it into this lender, and now we found out a lot more stuff, which Becky told you about. So that deal from the day that they submitted in until the closing day, hopefully tomorrow, it's I think 2.5 months, 2.5 months or 3 months. We spent a lot of time on that deal, but at the end, the clients are very happy, very appreciative because he does need the money for other projects. So that is one thing about working with us. A lot of people are asking us, hey, what is your niche? We do not compete on rate. We do not compete on rate. Okay. We compete on service. Our goal is that we never give up. We will relentlessly helping our client from one solution to another solution to another solution to another solution. Quite frankly, every time when I close a deal, a lot of clients are very appreciative to us. But of course, there's a small portion that they will never come back just because they experience the things that they've been through. But it's okay. At the end of the day, we look at them and say, hey, we helped you out. We help them out. And that is what it counts. So that is our niche. It's not about we have the lowest interest rate. We never have the lowest interest rate, but I can guarantee you that we have the best service with our team. So that is what happened with market change, economic change. The next one, hard. This one is I should say this one is the biggest one. Incomplete documentation, incomplete documentation. So when we start the process, we will give everybody a list of what we need to collect. We have 10 items. One is missing, this file is not going to go anywhere. Okay. You give me 10 items and they are not what we ask for, this file is not going to go anywhere. And oftentimes, the the longer the documentation keep being dragging on, the harder for this deal to close. Because once we tell the lender that, hey, this file is ready to go, they will open a file on their end. Now they expect us to start to submit documentation to them. If the client, I see all the time, we have clients that we need 10 things. They give us one thing today. 3 days later, they give another thing, and it's not correct. We have to go back and ask for the correct one. And then they will give another thing 2 days later. By the time we collect the entire documentation from them, it's already 1 month past. And to a lot of the lender, they don't like to deal with client like this. This is what they call the B paper, C paper client, meaning that this client is not willing to work with us. Even at the collecting documentation phases, it's already that much trouble. You can bet on it. Later on, once we start the underwriting, we will have a lot more document that needed from this client. And one thing about what the client that Becky was talking about, one thing about good about them is that they are very plump. You ask them for something, they give it to you. You ask for something, they give it to you. And that is what keeps the file going. And that's why it keeps the lender appreciative and keeps the lender have the motivations to close a deal. But on the other hand, even though a deal is very, very good, we have a lot of simple deals. But when you ask for documentation, they don't give it to you. And the lender will just keep dragging on and on and on and on. And now they have more questions. Now they're losing their patience. Now they don't want to deal with it. And now they put the deal aside and they will kill the deal. So that is what happened. And I strongly, strongly, strongly suggest you, I mean, for those of us in this room right now, think about this. Do you have any clients in that situation where they never provided documentations to us? And if that is the case, please help us to follow up. And that's how you earn, at least you earn how you earn your commissions. Okay. So that is one of the incomplete documentation and incorrect documentations. We asked them for bank statements. They give us a screenshot. That is not bank statement. We asked them for driver's license. They give us a credit card. That is not what we asked for. So that's why another thing that I emphasized last week is that, hey guys, if you want to make your 45, 46%, be sure that you review those documentations for us. If those docs are not what we asked for, if you don't understand what it is, most likely we don't understand neither. Help us to collect the right docs for us so that we can help you. So, so that's another thing, incomplete documentations. That's a big killer. Tenant and lease issues. So tenant and lease issues apply to commercials. For example, you have an apartment, um, 20 units, and you only have 50% occupied. I already shared that example, right? So now that property is not fully occupied. We cannot give you a DSCR loan. On the other hand, let's say you purchase retail. You have one unit, and that one unit is one, let's say, grocery store. There's no name. It's just a local brand grocery store. And the lender look at the lease. The lease is going to expire next year. Now, to the lender, this is a very, very risky um, um, tenant because again, we don't know who they are. Can they support their business or not by next year? We don't know. So again, when lender looking at leases, they're not just looking at how much money you make a month. They look at what type of lease is this. Is that a triple net lease? Is that a gross lease? Who is renting it? Who is leasing it? How long is the lease? When is it going to expire? Every single month or every single year, do you have increase in rent? So on and so forth. So those are what the client's looking for. So at the initially, when client tell us, of course, many of them they don't know what to tell us. They would say, "Oh, do you have a client? Do you have a tenant? Yeah, I have a tenant. The tenant is paying me $10,000 a month. Good income." So to a lot of people would think, "Wow, it's $10,000 a month. It's very, very good." But once we look into the leases, that's not the case. Okay. So, in some other cases, for example, you have again a retail that you divide it into 10 different 10 different unit. But one unit, it's a grocery store that occupy 50% of the space of that retail, and the other nine occupy the other 90%. So now the lender is going to be also very scared. So because this one tenant occupy majority of the space, which comes from the majority of the income, and what if this tenant goes away? So those are what the lender's looking for. So once the lender do not like the leases and do not like the tenant and how the lease looks like, now they will change the structure of the loan. And once the loan structure changed, most sometimes the client will just say that, well, now this is not what I'm looking for. And now the deal is dead. Okay, so that's another reason for it. Number 10, lenders regulatory constraints, meaning that is very similar to the market, but also from the lender. Lender, as you know, they fund many different assets. They have pool of money. The pool of money, for example, 10% goes into retail, 10% goes into office building, 10% goes into multifamily, so on and so forth. So that pool of money that they have, they already divided into many different sectors. So sometimes when we go in, let's say for example, this is a retail, okay? When we go in, they still have money left for the retail sector. But however, doing underwriting, some other loan got funded as a retail. So they have no more money for that sector. So then they will come back to us saying, "Oh, sorry, Alan, we cannot fund you anymore because we've run out of money for that particular sector." So in that case, then we have to look for another lender. So that in that case, nobody's fault. But because they don't have any more money allocated to that particular asset type, then we cannot move forward. We have to look for another lender. So those are many different reasons why the loan cannot get close. So here I give you some other additional reasons that is we can go through it pretty quickly. Inexperience, borrower inexperience. That's one thing that we talked about. In our line of business, experience is very, very important. We oftentimes have people come up to me saying, "Hey, Alan, I just got out of college. Aaron, I just quit my job. I want to purchase a business. Can I do that?" Well, of course, you can do whatever you want. But the thing is that can I really get you a loan? A lot of people come to saying that, "Hey, I want to open up a restaurant." The first question I ask is that, do you have any experience? for running a restaurant? Do you have any experience to do a FedEx route? Do you have any experience to run a mechanic shop? Whatever that might be. If you don't have any experience, most likely you cannot get a loan. So startup is not a favorite thing for any lender to consider, even with SBA. They do not like startups. So experience is very important. Change in business plan, and that's another one, especially for constructions. We have client come to us saying that, hey, Alan, I'm going to build I'm going to build an apartment. Then we ask them, what is the exit? After you build it, then what? Then they say, well, if I could sell individually, become a condo, I can sell individually, or I can run it as an Airbnb, or I can do it as a long term, or I can do it as um, um, corporate housing. Yes, there are so many different options, but lender do not like to see because every single one of those options causes different underwriting guidelines. I mean, underwrite differently. So we have to tell the client lender what exactly do you want to do. Now, when we go in, we're saying that okay, fine. He's saying that I'm going to keep it and I'm going to rent it as a long-term rental. Good. That is how we are going to underwrite this. But then we have client halfway through, they come back to us saying that, oh, I don't want to do that anymore. I want to change it to corporate housing. I want to change it to short-term Airbnb. Oh, no, 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 no. The lender already spent so much time, or even the appraisal is already done, their underwriting is already halfway through, and now you change the plan, which means that they have to do everything all over again. Now, some lender might play along with you, but they might ask for a deposit. I mean, you're wasting my time. So if you want me to underwrite the whole thing, give me a $10,000 deposit, and I play along with you. Some lender would just straight out like, no, I'm not going to do this thing. I'm going to kill this deal. So changing business plan is definitely is going to cause a lot of trouble. Insurance issue. Insurance issue. Some properties very difficult to get insurance. We just funded a campsite, a campground. You would think a campground just like any other asset. But what we found out is that it took us a long time to find an insurance company that is willing to insure that piece of property. And some property lender do not even want to insure. For example, some of the property got fire damaged or water damage, so on and so forth. So insurance issue, that's another reason that it cannot get it close. Um, Sponsorship issue, that's the client himself. The client either doesn't have enough credit, not enough liquidity. We talked about that already. Misaligned meaning that, hey, the client expected one thing. They come in, they're thinking that, hey, I have the best client, I have the best property. I'm supposed to get 6%. I'm supposed to, no fees for this type of loan. But in reality, it's not the case. When we offer a term sheet, it's totally different than what he's expected. So now there's no alignment right there. So the client would just say, no, I'm not going to do it. So that and another reason that the file goes away. Borrower misrepresentation. They tell us that basically they lie. Okay. They tell us they tell us something that is not true. And we found out. So obviously that is automatically denial. Subordinate financing conflict. Some lender, keep saying some lender, some client, they have property that already have a lot of value in it. But their first lien, they got the first lien many years ago with so low interest rate. They don't want to touch it. They just want to get a second lien out of it. Now, in most cases, I'm able to do that. We are able to do that, but we also need to know who is the first lien. And sometimes the first lien do not allow a second. There are many lenders out there like this. They do not allow a second. And once you get a second, then the loan becomes default. And we run into a client that comes to us saying, "Hey, Alan, I need you to help. I need my help." And we find out that that is the reason. They knew they cannot get a second loan, but they did get a second loan, and the property go into foreclosure, to go into default. So again, once we found out that the first lien does not allow a second, and if the client does not want to do a cash out, basically means that get a loan, pay off the second, and get the cash out, then this loan is going to die also. Of course, and another thing is that shopping around. That's another thing. A lot of the client out there is shopping around. They come to us. They give us, they use our term sheet, and now they turn around, they go to somewhere else. So we often have experienced something like this also. So again, those are the different reasons. Now, obviously, there are a lot more, but I believe those are some of the major reasons that we see why loan cannot close. So next time when you talk to a client, learn how to listen to them. Okay, learn how to ask questions. So the more you ask, the more you dig out, the more you realize is this loan doable or not. Now we don't expect you to do that. So what we suggest you to do is that what we need you to do is that from now on, every deal that you submit it in, we, the advisors, myself, George, Becky, Alan, or some of our advisors, need to talk to your client, need to interview your client first. Because we also, because of the uniqueness of our platform, we also found that the client tells the consultant one thing, but the consultant doesn't understand. By the time the consultant tell us, it's a totally different story. So we base on the different story to structure a loan for the client, and the client saying, "What are you guys doing? This is not what I want." So from now on, we need to talk to your client. We need to have an interview with your client for at least a few minutes so that we understand what he or she is trying to do. So that way, the success rate will be much, much higher. Okay. So those are all the points that I have for tonight. And we have a few more minutes. So let's open up the floor. Any questions, comments, suggestions? Feel free. If you want to talk, please unmute yourself or raise your hand or type your questions in the chat box. Okay. Nothing? Are you guys still there?
Hey, Alan.
Hey, Tom.
Hey, great job as a lender myself. You're right on the button on every one of those. It's it's really nice to know you know your business. I'm new. We just met, so
Yes.
yeah. So thank you so much for this. This was an extremely valuable lesson.
Well, let me
Uh,
let me introduce Tom right here. Tom is our lender, ladies and gentlemen. Now, you know that we do a lot of things, but there's one thing it's very difficult for us to do. It's manufacture homes. We have yet find a lender that can do manufactured homes. Ladies and gentlemen, let me introduce you to Mr. Tom Chase. He's the manufactured home lender. He's the king. He can fund manufactured homes. Now we have a place to go. So, Mr. Chase, I mean, you are music to our ears, and you're angel singing on my tongues. And again, so glad to have you to be part of Sequoia. So you will have all of our manufacturer businesses from this point on.
Thank you for that. I appreciate what you went through here, and just a shout out to John D'Angelo for introducing me to you. Thank you, John.
Absolutely, Jim. Thank you.
Jim, I mean.
Yep. So again, this is what this platform is all about. It's all about connections. We all get together. I always believe one plus one equals much bigger than two. So when we all get together, we can do a lot of things for our community. And for the longest time, we have struggled to look for a lender that can understand manufacturing home, willing to do manufacturing homes. But now we have one. And Tom, tomorrow we have that conference call, and uh, you know, the lady that you're about to talk to, she is very passionate about what you do, and I'm sure that she's able to help you to raise the fund that you need. Okay. All right, 9 o'clock. If nothing else, ladies and gentlemen, thank you so much. And not,
I want to say one thing too. Hey, Alan, it's Ken.
hey,
Uh,
Ken.
It's good to see you again. Sorry, I've been super busy the last 4 to 5 months since I signed up with you guys.
No
Today's
worry,
the
man.
first time I actually sat down and listened to everything that I could. Truly appreciate everybody being on the call, and thank you for your knowledge. And I'm looking forward to being on the here every Wednesday at 4:30 from now on. And I got a lot of deals for us too that I need to bring your way once I get the hang of everything. I'm gonna rewatch all the videos that you put on the YouTube channel too as well. So I want to say thank you so much, guys.
Hey, no worry, man, Ken. Hey, thank you so much for coming back. And yeah, let's do some business together. Okay,
I
guys?
sure will.
Yep. All right. So until then, see you guys next Wednesday. Remember, if you want to go to New York, please register. Good night, everyone.
Good night. Thank you, Alan. Thank you, Peggy.